Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. I hope that everyone's having a great week so far. And certainly the last week has been interesting. We talked about that huge short cover induced market volatility last week where we saw a handful of companies absolutely skyrocket in price. And as we warned last week, would eventually come crashing down. And that's really what this week's market update's all about. It's about taking advantage of Wall Street stupidity, right? And we hear from a lot of clients and advisors and consultants and analysts about how Wall Street takes advantage of retail investors and how the game is fixed. And the reality is, as someone that's worked on Wall Street for close to 16 17 years now, is they're as stupid as they look. In other words, when we think of the amount of attention that was spent on paying attention to companies that were absolutely irrelevant to today's and tomorrow's economy, believe it or not, at hedge funds, at mutual funds across New York, Toronto, London, Hong Kong, people were glued to the action in these handful of stocks and trying to draw out conclusions about the wider stock market and about companies that had nothing to do with those irrelevant firms. For an investor that was opportunistic and could see through that noise, they could see that, oh, wow, we have short-term disruption taking place across the wider stock market with healthy companies that are growing revenues and revenue, sales, earnings, free cash flow north of 20% that have nothing to do with this story. And suddenly I can buy these companies 10, 15% on sale. Yeah, that's a no-brainer. And that's the way we need to look at the stock market. That's the way we need to navigate short-term noise, is that a lot of this is junk. And a lot of the times people that work on Wall Street, that work at investment firms, they need a reason to feel like they're working on a day-to-day basis, right? In other words, what are they doing? And they're paying attention to the noise and the risk in the market and blah, blah, blah. And the reality is that it's all noise. What you need to do is come into the firm, or if you're a home gamer, get on the computer, do your research, and continue to pay attention to the developments that are taking place company by company in your portfolio. Is that value line increasing with the companies you're invested in, or is it decreasing? And what are the underlying stock prices doing? And if there's a disparity or divergence between the two, take advantage of it. That's what investing is all about. So today, the three big takeaways are, the bottom line is sometimes the market just needs an excuse to catch its breath. We had a big, strong upward move in November and December, and January was all about catching its breath. In other words, similar to a marathon runner, we can't sprint the entire marathon. Sometimes we can run a little bit faster, but then sometimes we got to slow down, pace ourselves in order to complete the journey. And that's really what January was all about. The second big takeaway is that momentum in the economic recovery is quietly building up. And it's something that not a lot of people are talking about. And we're going to go through the momentum in vaccinations across the U.S. There's a lot of negative stories about how the U.S. has dropped the ball. And certainly the uptake at the very beginning was slow. But like many things, the initial start of something is slow, and then it begins to quietly ramp up. And then, of course, momentum begets more momentum. And then lastly, those secular growth leaders that we cut our teeth on, that we focus on day to day, they're beginning to resume leadership. I think you've seen it in the performance numbers, which we'll go over. And at the end of the day, that's where we need to keep focus, right? We can't get caught up in the junk of short-term trading, and especially with firms that are irrelevant in today's economy. Real quick here, in terms of the performance in 2021, the tactical opportunity strategy is up just around 6.74%. Had a bit of a down day today, but that's to be expected after 3 strong days in a row. So overall, year to date, up 6.74% in 2021. Over the last year, that opportunity strategy is up 102.84%, and going back to inception, up 249.70%. So again, our war against mediocrity and low-cost indexing products that voluntarily put our money into mediocre companies continues. And the battle's going to sway up and down, but over time we hope to continue building up value and really opening investors' eyes that stock picking creates value, not just if you hire us to do it, but if you do it at home. And I think last week, if there was any message from last week, it's about the democratization of investing, and we want to help investors do that, and hopefully we can continue these results going forward. It's not easy, but we try our best, and we'll go through ups and downs, but more importantly, I think for us and our clients and our advisors, we just want to have fun while doing it as well. So far, these are the results. If anyone has any questions, definitely give us a call on that. Now, the recent volatility of last week. If you remember, we actually had this slide last week. And one of the things that we noted was that we get these we get these intermittent blips in volatility, right? In other words, that demand for portfolio insurance and protection. And generally speaking, within an upward trending market where short-term momentum is strong and we're in a long-term secular uptrend, those quick pops in volatility tend to be short-lived. And the chart from last week actually ended with this pop, and we said we wouldn't be surprised to see that come right back down. And in fact, not only did it come back down, but the 40% drawdown in volatility that we've seen over the last 3 days is the largest on record. And when you get outside downward moves in volatility like we've had in the last 3 days, that tends to be a very positive leading indicator for the stock market on a forward-looking basis. So we really, really love to see that. One other quick note is that now everyone's jumping on this train of, well, you know what, should I just pay attention and buy stocks with high short interest? Well, maybe it makes a quick trade, but I hope you're paying attention, because long term, it actually destroys a lot of value in investor portfolios. So we can see here the relative performance of stocks that have high short interest off major market bottoms can outperform for 1 month, 3 months, even 6 months. But look what happens after 2 years. They structurally underperform. And why is that? A lot of times stocks are shorted for good fundamental reasons. We're talking about businesses that are, at the knife's edge of going under, being disrupted, being basically taken into oblivion. And so, yes, sometimes you can have, lucrative short-term trades, but for our investors, for ourselves and our products, we're staying focused on secular growth, where this 24-month number is flipped to the upside, not to the downside. So I think that that's an important thing to pay attention to. And again, when we looked last week, this was the exact same chart that we looked at last week, which pointed out that the RSI, the relative strength index of the S&P 500 on a very short-term basis, was very, very oversold. And sometimes what we like to do is look back and say, were our indicators correct? And if they weren't correct, why were they not correct? But fortunately for last week, a lot of these indicators proved to be correct. And basically what it said was that on a very short-term basis, we got very, very oversold, while the overall breadth of the market was strong. So we didn't see widespread selling in terms of people taking serious positions off their portfolios. So I think if anything, what happened last week allowed the market to work off some of that short-term froth that we see that sometimes builds in the market as market prices melt higher. And when you work off that froth, it strengthens the foundation. It doesn't allow speculative activity to get so out of control that it takes down the entire market, as you saw in the year 2000 or 2007, 2008. So it prevents those big market tops from ever forming. At some point, that'll happen years from now if our work proves to be correct. But for now, where the market's very healthy, foundation is strong, and that's what we want to see. And the other area that we looked for a speculative flush, as we call it. So when we're in a cyclical recovery within a secular bull market, in the very short term, we get these quick sell-offs, quick punches to the gut. And one thing that we look at is, does volatility, or otherwise known as a VIX, become inverted? And what does that mean? That basically means is that our investors paying up for short-term protection versus long-term protection. And a good way to think about this is, imagine if someone was willing to pay more for life insurance that would pay out over the next month versus over the next year. Hopefully we all have a higher chance of dying over the long term versus the short term. So when investors are willing to pay a higher price for portfolio protection that expires in a month versus 4 months, that means there's a sense of panic taking hold in the market. And that's very emblematic of strong, sustainable bottoms taking hold in the market. And that was something that we saw last week and gave us a lot of confidence that the market would resume its upward trend. We also saw a lot of positioning get flushed out. So when we look at the amount of what's called de-risking or degrossing in investor portfolios. So in other words, investors being forced to cover their shorts, sell their longs, that takes down VAR in the portfolio. In other words, value at risk in the portfolio, just a fancy term for risk. That also tends to be emblematic of these sustainable bottoms that take hold in sort of more healthy long-term bull markets. Now, when all of this noise was taking place, there was real news that was actually that should have been reported on. And the media loves to report on bad news and pessimism. Why? Because it's sexier, because it elicits eyeballs to turn on the TV and watch the news. Good news is not that exciting. But what was slowly taking place amidst all this noise is that vaccinations in the US are accelerating, right? We look at the percentage of US states that are 15% or more vaccinated, we see that accelerating across the board. We see the number of cases beginning to drop. So as vaccinations are picking up, cases are dropping. Now, is that a statistically significant data point? Probably not, because it's just one data point, right? So in statistics, you want to see a number of different observations that lead to the same conclusion and have high correlation with each other. But certainly that's a good pattern where we see vaccinations uptick and cases come down. So the question is, where else is this happening, right? What we see is in the UK, the percent of the population that is vaccinated is now close to 15%. In Brazil, it's 1%, and in South Africa, it's almost 0. And what's interesting is that in Brazil, the case count's been relatively flat, but in the UK, we're seeing a big downward move. South Africa is kind of an interesting chart, because we don't really have data on South Africa in terms of its vaccinations, but it's had a massive downward tick as well. But again, the UK coming down big as they're vaccinated, and Brazil staying flat with very little vaccination. Meanwhile, look what's happening in the US. The cumulative amount of Americans that are vaccinated is quietly building up. We're over 31 million Americans that are vaccinated. And remember, that cuts transmission points. So that has an exponential impact in terms of overall virus transmission. Plus, you add on top of that the number of people that have already had COVID and have antibody resistance. I think that says something about the sustainability of the overall recovery, the sustainability of reopening the country. It's something to pay attention to. It's something we're paying attention to. The other thing that's been happening in the market is that overall, secular growth is starting to reassert its control in terms of relative performance. What we've seen is while a lot of people have been chasing these more cyclical stocks, they're called sort of the reopen stocks or the center of the COVID storm stocks. We prefer to call them crappy company stocks, which is the reason why they've relatively underperformed. While they've been chasing those names, value versus growth has started to underperform again, as exhibited by this blue line. And we see this a lot when crowds rush in to try and chase short-term returns, they often get burned. And we can see that here, when we look at cyclical sector ETF flows massively spiking up. And when we look at cyclical minus defensive sector ETF flows massively spiking up, meanwhile, that secular leadership is resuming control. And we can see that with technology, right? So technology versus the S&P 500 equal weight index and the S&P 500 traditionally weighted cap weighted index is breaking out after a multi-month consolidation. Oh, and guess what fund flows are doing? Nothing, right? We had a big COVID surge and then been relatively flat as earnings and revenue build into these names that we love. They're beginning to resume an upward trend, while fund flows have been relatively tepid. And that's not surprising. Price action historically tends to lead the direction of investor flows because investors don't like to take leadership. They like to chase. And for us, we want to skate to where the puck is going, because if we can skate to where the puck is going, that money flow eventually gooses up those stock prices and we benefit from it versus buying those prices at a higher endpoint. So again, a very positive development. And of course, something we look at week in, week out, as everyone knows, is the credit markets, stable and healthy. One thing that really stood out to us last week was the fact that through all the noise and disruption, credit spreads did nothing. In fact, they fell. And in other words, the level of credit risk fell. The level, I should say, the level of implied credit risk fell, and the demand for portfolio protection fell last week. So I think that's important to point out. It's or I should say the level of portfolio bond protection fell. So I think that's an important tell point. It's something to pay attention to. We do a lot of work in the credit markets because they provide the foundation for the overall global economy. They allow credit to flow from suppliers of loans to people who are to private businesses and individual citizens that need credit. So when that pipeline is clear and there's no disruption, the economy tends to function well, and we see that exhibited in stock prices. So overall, as the short squeeze circus has subsided, investors are rediscovering the value of secular disruptors. That's our bread and butter. That's what we cut our teeth in. We need to stay focused on that because that's how we create value long term. And so for us, that whole distraction last week provided a fantastic entry point, right? If we look at, when we look at how our portfolio has performed since Friday of last week, I think we're up 7% or so. So again, a great entry point. Vaccinations are laying the groundwork for a sustained recovery, and we're seeing that secular growth is resuming leadership. That's great for us. But more importantly, I think that's great for innovation. That's great for American economic leadership. So if anyone has any questions, feel free to reach out to your advisor. We're here to help. If you have any questions whatsoever, again, if you can't reach your advisor, feel free to reach out to us at 888-543-3776. I hope you have a great week, a great weekend when that arrives. And again, thank you for all your business and your loyalty, your friendship and advice. And again, if you need any help whatsoever, we're here to help. And have a great week. Thanks again.